Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Happy Friday. Hope you guys are doing fantastic. Happy fall. It's officially fall. Well, fall has started out quite well. Rates are better this week pretty significantly from where they ended last week. We started the week off pretty good. We did see some economic numbers that came out that helped interest rates. The beginning of the week, we saw personal consumption expenditures, which is the Fed's favorite measure of inflation, and that came in at an increase of 1.3%. Expectations were for 1.2%, so it was slightly better than expected. Personal spending came in flat, so that's anti-inflationary, and that helped interest rates. And actually, personal income was a little bit worse than expected. So both those things helped interest rates. And pending home sales were actually down about 1.4% from the previous month. Now, the housing market has been hot, so the fact that it's maybe slowing its rampant pace is not necessarily a bad thing, but we did see those pending home sales come in a little bit lower. But the market was waiting for the employment report, and that came in today, and it was a big surprise. Expectations were for about 205,000 jobs added to the economy, and only 142,000 jobs was the number. So it was way off expectations. Also causing some indigestion with the market was that the previous months were revised downward about 60,000, so further weakness there. The unemployment rate came in about 1.5%, which was as expected. Also, when you peel back the onion to some of this report, there was some weakness within the report itself. We did see that hourly earnings were flat, so there's no inflation there, and that helped interest rates. And actually, hours worked were actually down. And the labor force participation rate, which actually measures the amount of people who could be working and if they're working, was only at 62.4%. So that got worse, and that's the worst level since October 1977. So all those things have caused interest rates to get better. Stock market opened down about 228 points. The Dow Jones Industrial Average opened down over 200 points. However, it has since recovered some of those losses. So you'll just see there's just going to be a whole lot of volatility here. Now, at least at 11 Eastern time, it was only down about 100 points. But there's just some overall general weakness. Now, also a good trend for interest rates is we've broken through a resistance level of the 200-day moving average. I've talked about the 200-day moving average and how important that is in previous Java with Jared. Earlier this year, we broke beneath it, which was bad for interest rates and set a trend for rates to kind of continue to get worse. Now we've broken through that level, and we're back above that 200-day moving average on the price, which drives yields down. We've also seen the 10-year note. That is down below 2%. We're at 1.96%. So all those trends are very positive for interest rates right now, and we might see extended rally here with a lot of volatility, but extended rally here maybe towards the end of, at least maybe the next 2 weeks or so, and maybe towards the end of the year. Again, with a lot of volatility. And again, once again, all bets are off on what the Federal Reserve will do on the October or December meeting. Most believe that the Federal Reserve will not increase credit in October and probably won't in December either. So again, the Fed increase to short-term interest rates is probably off the table with these weak numbers. So we'll keep you informed. Again, there's going to be a lot of volatility as always, but the trend is now for at least the next 30 days that we'll see interest rates remain very good, probably towards the end of the year. And as always, we'll let you know how things change as things move forward. If you're working this weekend, so are we. Hope you have a very wonderful weekend. Thanks for joining me with Java with Jared, and we will talk to you soon. Bye-bye.